So this is the foundation of price action analysis for beginners. So in this course, you're not only going to learn what price action analysis is, but I'm going to show you the 4 stages that the market goes in when it is moving. And also I'm going to give you a complete step-by-step strategy that you can start using today, even if you haven't placed a trade before. So what is price action analysis? Price action analysis is the foundation of analyzing charts without using indicators. So price action analysis combines of 4 stages of the market. The market moves in 4 ways. So I'm going to explain them step by step. The first one is the accumulation stage. When it comes to the accumulation stage, you have to understand that the market, before it moves to the upside, it starts by building momentum. And this is where you get the accumulation phase. So it is just a range that comes before the market stretches to the upside. So the accumulation is just a phase where the market is building momentum to go to the upside. So the market have to create this momentum before it moves to the upside so that there is enough volume for the market to move to the upside. So if you want to trade in this accumulation phases, you want to wait for the breakout of the market to go to the upside, which other people will say a reversal. And how do you get this reversal? I'm gonna show you a step-by-step strategy, but first you can use support and resistance. Don't worry, I'm going to give you a step-by-step strategy in a minute. The second phase that the market goes in after the accumulation phase is the advancing stage. And this is when the market is starting to create the momentum and starting to create the uptrend. This is the best point for you to look for buy positions. If the market is starting to create this momentum, you have to jump into the market. But before you jump into the market, you need to also beware of what is called a kiss of death. The kiss of death comes after the market breaks above the accumulation phase, and then when you think that the market is going in a advancement phase, it then reverses and comes back just to take out your take profits or the take profits of the initial buyers. So this is very important to understand. So if you are in an accumulation phase or in an uptrend, you are looking to be buying the market. I'll show you, as I said, a complete strategy. After the accumulation phase, when the market moves for a very long period of time, or maybe for hours, it then have to create a distribution phase. Why does it create a distribution phase? What happens is, if the people are keep buying and the uptrend is going up, there's a point where most people will be thinking of getting out of the market. This can be a level of support or resistance on a bigger time frame, but most of the time the market will have to create this distribution phase so that it can release all the momentum that have been building in the advancement phase. Then once we have this distribution phase, we also have the declining stage. So the declining stage is the start of a downtrend and the momentum of the market going to the upside. So what happens is, if the market comes from an uptrend and it goes into distribution stage, it have to either go to the upside or break to the upside, because this distribution can also build momentum for the uptrend to continue. But most of the time the market is going to reverse after this distribution phase and it goes into the declining stage, which is just the opposite of the advancing stage. Now it's very important to understand these 4 phases, because the strategy that I'm about to show you right now, you need to trade either when any of these phases is starting out or when the distribution or accumulation is about to end. So if it is an advancement phase, you need to place the trade when it is starting. You don't want to place the trade when the market is going into distribution. You don't want to buy when the market is going into distribution. You also don't want to sell when the market is now entering in the accumulation phase, because after that phase, the market is going to likely reverse. So with that being said, let's jump into the strategy and let me show you what you can do to place your trades using price action. So the strategy that I'm going to show you is very, very simple, but you need to pay very close attention. So the first thing that you want to do whenever you open your charts and you go to your time frame, you can go to 5-minute time frame, 15-minute time frame, 1-hour time frame. The time frame doesn't matter. You need to know what phase is the market is in. So for example, if you look at this market, we can see that we have a clear decline phase here, which was a clear downtrend, and then the market get into this range right here, which we can call, which can be either an accumulation phase for the future uptrend, or it can be just a range where the market is going to break to the downside. So you don't want to place your trades right in this phase. You want to just draw this phase, and then you mark the bottom of it and the top of it, and then you wait for where the market is going to break to. If the market breaks to the downside, it means the decline phase might be continuing, and this can be just a small range in a bigger trend. But if the market breaks to the upside, it might also mean that the market have just finished accumulating, and then now we are going into advancement. And this is where you want to place the trade. You want to catch this trend earlier so that you can give bigger risk to reward ratio, and also your trades can go into your take profit a little bit faster. So let's say we identified this downtrend, we identified this zone, and then the next thing that we want to do is we want to find areas of support and resistance, or areas of value. So if you mark the top of this zone and the bottom of this zone, you are going to see that the market is moving inside this zone. So when the market breaks to the upside, most people will jump into the trade as a buy trade, but I don't want you to do that, so that you can avoid fake breakouts. So what I want you to do is just mark this zone, and if the market breaks to the upside, don't trade right away. Wait for the market to reverse back into the zone that you just marked. Even if it breaks to the downside, wait it for the reversal. Wait for it to reverse into the zone that you marked, and when it reverses into the zone that you marked, you can wait for the most common candlestick patterns like bullish engulfing, the hammer, the morning star, the shooting star, all of those candlesticks. If you want to learn more about candlesticks, I will leave a video on the top of the screen right here. But you want to wait for the market to come back into the zone, create a candlestick pattern, and then after that you want to place your buy trade if it breaks to the upside. So if you buy at this zone, the next thing of course that you want is to know where your take profit and stop loss is. So the best way to get a good take profit and stop loss here is to just use 1 to 3 risk to reward ratio. Just make sure that your stop loss is below this zone, or even below the whole accumulation phase if the accumulation zone is small. But if it is big, there's no point of putting the stop loss all the way down. You just want to place it a few pips below your zone. You can use the ATR indicator for that. And then your take profit should be 3 times the risk, especially if you get the trade just after the breakout, because if this is an uptrend, of course, it's gonna take a lot of time and you can profit a lot of money. So that's the first way that you can trade this strategy. The second way is to trade this strategy if the market is already in an advancement or an uptrend or in a decline or downtrend. So let's say you missed the accumulation phase, you didn't see it, and then the market keeps going to the upside. What you want to do is you want to just look into that zone, into that advancement zone, and then whenever the market makes a big return or a big reversal, you want to mark the top of that reversal as a level of support or resistance, and then you want to wait for the market to break above that zone. When it breaks above that zone, do not place your trade directly. Wait for the market to reverse and retest that zone, and then when it comes back, look for confirmation with candlesticks. If the market is about to reverse, most of the time it's gonna show you big wicks of the candlesticks, and then you can see candlesticks like bullish, bearish, engulfing candlesticks, and then at that point, that's when you buy. So step number 1 for a sell trade, find a market which is in a decline phase or in a downtrend. Step number 2, draw major levels of structure. Step number 3, wait for the market to break that level of structure and then come back to it. Once it comes back to that zone, you want to wait for a candlestick pattern confirmation. Look for candlesticks that have bigger wicks to the upside or to the downside, but it shows you that there is imbalance between buyers and sellers. After that, you want to place your trade. So a secret that I wanted to tell you, that if you watched this video up to this point, it shows me how serious you are, and I want to pick one person that I just give a small $20 account to trade for free. So if you watched this video up to this end, just comment below with price action, and I'm gonna pick one lucky winner who is going to get a free $20 for lunch, or maybe to put in your small account and try to grow it. Thank you for watching. I will see you in the next one.